XRP is up. Global conflict is active. Oil futures are spiking. And the mainstream crowd is completely confused about why the cryptocurrency market is not collapsing. Here is what they are missing. The market did not just react to this crisis. The market spent 2 months pricing in a version of this crisis that was 10 times worse than what actually unfolded. A version where Russia backed Iran, where China backed Iran, where oil went parabolic with no ceiling and no out, where the Federal Reserve was forced into permanent high interest rates, where the conflict spiraled into something multi-year and uncontrollable. That scenario did not happen. And the market, which had already sold off 68% in anticipation of that scenario, is now repricing in real time. What I am about to show you is not a prediction about what happens next. It is an explanation of exactly what already happened, why it happened in this sequence, and what the specific signals are that determine whether the worst is truly behind us or whether there is still a more dangerous scenario developing. This is the analysis that is not being explained the way it should be. Let me break it down. Welcome back to the Calm Analyst, where we do not react to headlines and we do not chase panic. We read the mechanism, we read the sequence, and we explain what the structure is actually saying before the crowd figures it out. Today we decode why XRP is going up during a global crisis, what that tells us about how this market actually works, and exactly what to watch from here. Let's get into it. Let's start with the hard truth that most people watching this crisis unfold are fundamentally getting backwards. They are looking at the conflict and asking, why is crypto going up? This makes no sense. There is a war. There is an oil disruption. There is global uncertainty. Why are risk assets not collapsing? That is the wrong question. And the fact that they are asking it tells you exactly how little they understand about how markets actually price risk. Here is the mechanism that most retail investors never learn. Markets do not react to events. Markets react to the difference between what an event actually is and what the market was already pricing in. That gap between the feared scenario and the realized scenario is everything. It is the entire explanation for what you are watching right now. Let me make this concrete. Starting in early August, prediction markets began significantly pricing in the probability of a major escalating conflict in the Middle East, not a small skirmish. A scenario involving Iran, potentially backed by Russia and China, with oil infrastructure targeted, the Strait of Hormuz disrupted or closed, oil prices going genuinely parabolic, and the United States Federal Reserve trapped between fighting inflation caused by an oil shock and supporting an economy under geopolitical stress. That was the tail risk scenario the market was pricing. Now look at what actually happened. The conflict escalated, yes. Oil futures moved, yes. But Russia held a small naval drill and left immediately after. China has made clear its priority is stability and economic access, not military confrontation with the United States. OPEC Plus is actively discussing increasing production to counteract the disruption. And the United States, through a tactically intelligent positioning move targeting Venezuela's oil production capacity before this crisis, already created a supply-side out that limits how far oil prices can sustainably run. The Armageddon scenario, where Russia and China back Iran, oil goes to $150 and stays there, the Fed is trapped, and risk assets collapse indefinitely, that scenario has not materialized. And the market, which had already sold XRP down 68% in anticipation of something in that vicinity, is now looking at the actual situation and repricing. This is not bullish because the situation is good. The situation is not good. This is bullish because the situation is significantly less catastrophic than what was already priced in. That is a completely different statement. And understanding the difference between those two statements is worth more than any price target anyone will ever give you. Let me give you the specific numbers so you understand exactly what was priced in, what has changed, and what the scenarios look like from here. XRP down 68% from peak to trough heading into this event. That is not random noise. That is the market systematically reducing exposure to a risk asset in anticipation of a sustained negative macro environment. 68% is not a correction. It is the market pricing in something genuinely severe and doing it before the event, not during it. Now look at the oil picture. Crude oil up approximately 11% on the monthly, Brent up 14%, gasoline and heating oil up over 20%. Those are significant moves. But here is the context that matters. The Strait of Hormuz carries approximately 20% of the world's daily oil supply. If it closes completely and stays closed, the math on oil is genuinely alarming. But that closure requires Iran to sustain that action against the combined opposition of the United States military, the economic interest of China, Iran's largest oil customer, and essentially every regional power that depends on those flows. China alone has enormous leverage here. Roughly 20% of global oil passes through Hormuz. Beijing's explicit stated priority is stability and economic access. Aligning openly with Iran against the United States risks sanctions, damages Gulf economic partnerships, and disrupts the very oil flows that China's economy depends on. Beijing will position for influence if Iran's leadership changes. They will not go to war with the United States to defend the current regime. That is the key variable. And that is why the United States' pre-conflict positioning against Venezuela matters so much to the math. Venezuela's oil production capacity gives the United States and its allies a supply lever that can counteract Iranian disruption without requiring a prolonged conflict. The math on a permanently elevated oil environment, the math that would force the Federal Reserve to hold rates high indefinitely, only works if there is no supply alternative and no resolution pathway. Both of those assumptions are now looking significantly less likely than they were 2 months ago. The worst-case math required a multi-front, multi-year conflict with no out. The actual situation has multiple outs, a shrinking coalition behind Iran, and a geopolitical isolation dynamic that is moving faster than most analysts initially expected. The math that drove 68% down is not the math that applies to the situation as it exists today. Now let me connect this directly to what it means for XRP specifically, and why the institutional picture matters here more than most people realize. Here is a fact that most retail investors do not fully appreciate. The institutional infrastructure build-out around XRP and the XRP ledger does not stop during geopolitical uncertainty. It does not pause because oil futures spike. The partnerships being built, the regulatory frameworks being completed, the banking integrations being structured, those timelines are measured in quarters and years, not in weekly news cycles. While the retail crowd was panic selling XRP on geopolitical fear, Ripple's conditional U.S. bank charter was moving through the approval process. The permission DEX amendment on the XRP ledger, the compliance layer that finally opens the XRPL's built-in decentralized exchange to regulated institutional capital, that activated. BNY Mellon, the world's largest custodian with $55 trillion in assets under custody, was operating as the primary custodian for RLUSD reserves. None of that stopped because of a Middle East conflict. And here is the institutional signal that matters most right now for the forward picture. The Federal Reserve's decision-making in this environment is not as constrained as the bear case required it to be. As the reference analysis makes clear, and this is important, the Fed can credibly argue that adjusting U.S. interest rates does not address the root cause of oil-driven inflation, when that inflation is caused by a physical disruption to a shipping corridor. Monetary policy does not open the Strait of Hormuz. That gives the Fed meaningful cover to maintain a rate path that supports risk assets, even while the geopolitical situation remains elevated. Add to that the political dimension. Trump has been publicly and consistently pushing for lower interest rates. A Fed that is already looking for justification to ease, combined with a political environment that strongly favors that path, combined with a geopolitical situation that provides credible cover for arguing that rate hikes won't fix supply-side inflation. That is a macro setup that is significantly more favorable to risk assets than the Armageddon scenario the market was pricing in 2 months ago. The smart money did not panic. The smart money held its structural positions, watched the geopolitical situation unfold, assessed whether the tail risk scenario was materializing, concluded that it was not, and is now positioned for the repricing that the retail crowd is only just beginning to understand. Let me tell you specifically what to watch from here, because this is not a situation where you can just relax and assume the worst is over. There are clear signals that determine which direction this goes. The single most important variable is whether any major power provides meaningful military or material support to Iran beyond the symbolic gestures we have seen so far. Russia held a small naval drill and left. China has been vocal about stability. But if that calculus changes, if we start seeing actual weapons transfers, actual military coordination, Actual backing that shifts the balance of the conflict, that changes the oil math, and changes the Fed math, and changes the risk asset math. That is the line in the sand. Watch it closely. Assuming the conflict resolves or stabilizes without major power intervention, which is the base case based on the incentive structures of every major actor involved, the sequence from here is oil stabilizes, bond market stabilize, yields cool, dollar softens, and the $7 trillion currently sitting in money market funds starts rotating into risk assets. That rotation is the mechanism that drives the next leg for crypto. On the XRP specific side, the Clarity Act remains in active Senate negotiation. The XRP spot ETF application is in process. The yen-backed stablecoin from SBI and Startable is scheduled for Q2 2026, which makes XRP the live bridge between dollar, euro, and yen stablecoins simultaneously. Each of those catalysts was on the calendar before this crisis. None of them have been delayed by it. They are still landing in the same window. And they are landing into a market that just demonstrated it has far more underlying structural strength than the bear case required. Here's the thing about a 68% drawdown driven by fear of a scenario that did not materialize. It creates a window, a specific, time-limited window where an asset that the market was pricing as if the worst case was guaranteed is now being repriced back toward a base case that is supported by real institutional infrastructure, real regulatory progress, and real adoption momentum. That window does not stay open indefinitely. It closes as the repricing happens. It closes as the clarity improves. It closes as each institutional integration that was building quietly through the uncertainty becomes publicly visible. And it closes fastest for the people who are waiting for more certainty before acting, because the certainty and the price move together. XRP exchange reserves are near multi-year lows. The liquid float was already contracting before this crisis began. The institutional demand that was building through the uncertainty, BNY Mellon, DXC Hogan, Franklin Templeton, Hidden Road, G Treasury, that demand does not show up in the public order book. It accumulates off exchange. And the tokens that move into institutional custody do not come back to market for a 15% gain. They are locked for years. The 68% drawdown created the entry. The geopolitical resolution removes the fear premium. The institutional build-out provides the structural floor. Those three things converging in the same window is not something that happens often, and it is happening right now. I want to be direct with you about what this week actually proved, because I think it is one of the most important structural data points this market has produced in a long time. A global conflict broke out. Oil spiked. The fear and greed index hit extreme fear. Every surface-level indicator pointed to significant further downside for risk assets. And XRP went up. Not because the situation is good, because the market had already priced in something far worse, and the realized scenario came in below that feared scenario. That is a display of structural strength that most retail investors fundamentally did not expect. And it matters, not just for this week, but as a statement about where the underlying bid for this asset actually is. When a market that has sold off 68% refuses to break further on news that would have devastated it a year ago, that tells you something about the quality of the hands currently holding the asset. Weak hands already sold. What remains is structural positioning. I am trained to distinguish between noise and signal. The noise this week was extraordinarily loud. Active conflict, oil spike, Hormuz threats, extreme fear indices, all of it screaming sell. The signal, market structure holding, institutional positioning intact, geopolitical tail risk not materializing, macro outs remaining available. The signal said hold, and the signal was right. Being early feels exactly like being wrong, right up until the moment the structure asserts itself. This week, in full view, with every reason in the world for the structure to break, it held. That is not nothing, that is everything. Here is the thesis stated simply. The market priced in Armageddon. Armageddon did not arrive. XRP absorbed a 68% drawdown driven by the feared worst-case scenario and refused to break further when that scenario failed to materialize. The structural bid is real. The institutional positioning is intact. The macro outs, Venezuela supply, OPEC production increase discussions, China's explicit preference for stability over confrontation, those outs are real. The geopolitical isolation of Iran is progressing faster than most analysts expected, and the regulatory and adoption catalysts for XRP are still on schedule. The crowd is asking why crypto is going up during a crisis. The informed already know. The crowd was pricing in the wrong scenario. The structure was never broken, and the repricing has only just begun. Price is a distraction. Structure is the reality. The question is not whether the worst is behind us. The question is whether you were positioned before the answer became obvious. In a market fueled by emotion and noise, we thrive on data and composure. Stay patient, stay rational. We do not wait for the future. We plan for it. Drop repricing in the comments if you made it to the end. I want to know who understood the mechanism, not just the headline. I'll see you in the next one.